Hello, everybody. Welcome to the fourth quarter 2022 iSectors webinar. Um, we have a new format, as you can see. Vern and I are showing our faces here. I'm John Cook, Senior Investment Analyst at iSectors, and Vern is the CEO, CIO, and founder of iSectors. Generally in the past, when we do this, we're not showing our faces and it's been kind of impersonal, but we wanted to put a little bit more of a personal touch on it for this quarter. So that's why you can see our lovely smiling faces here. And without further ado, I'll open the presentation here and we can get started. So like I said, this is our market review for the fourth quarter 2022. And to start, Vern is going to kind of give an overview of going into 2023 and, wrapping up 2022 in here, letting us know about some of the concerns we've heard from advisors about the markets going into 2023, some concerns they've heard from their clients. And so with that being said, we'll get that started right away and Vern can begin
Sure.
on this slide here.
Thank John. So we've iSectors continues to see stagflation as an ongoing concern. And we certainly know that individual investors are reporting their concerns about rising prices and their fears about recession, how this might affect their portfolio. And they're wanting to know, what are you doing about it? They're asking their advisors. Um, so in interest of time and to keep this short, we're going to give I'll give you kind of a short version of this, but you're always welcome to call us. Be happy to talk to any advisors that would like more information or would like to look at how they can blend our models at iSectors to achieve their clients' goals. But as you know, the Fed also is continuing to fight inflation with higher interest rates. So we really have a difficult environment, and clients feel this and are describing this. And you've got inflation, recession, and higher interest rates all at the same time, causing problems and causing concerns for clients and their advisors. So in short, kind of a short version of how iSectors has responded, of how our models have responded for recession. We've increased the quality dividend allocations in our portfolios. Um, in domestic equity, for example, we've reduced the amount of growth equities and increased the quality dividends in that portfolio. In our fixed income models, we reduced high yield a lot. John can describe that. And we've also added healthcare and utilities to the portfolio. So it really is a response, we think, to the recession slowing down of the economy aspect of what we see going on. And then inflation, we've increased gold equities and energy in the portfolios. We think it's a good idea that advisors allocate and maybe increase their allocation to inflation protection, the iSectors inflation protection model, for example, or the iSectors precious metals allocation. And then on interest rates, we continue to focus on short-term bonds in both our iSectors domestic fixed portfolio and our iSectors capital preservation portfolios. As you know, interest rates go up, bond prices go down, but the short-term bonds go down much less. And John will point that out and how that has helped us last year in the bond allocation, the fixed income allocations to the portfolio. So I'll let John take it from here.
Yes, thank you, Vern. That was good stuff, a good overview, and you've had plenty of experience talking to clients about a lot of these things throughout the years. And like you said, if advisors want to reach out to us, I'll have our contact information in a slide at the end. and you could reach out to myself or our director of business development, Scott Jones, as well. We'd be happy to talk to you and set up any calls if you want to speak with Vern as well. So thanks, Vern. Thank you for that. And like you said, I'm going to go now and give kind of um, a recap of the performance both in the fourth quarter of 2022 and I'll also hit on the full year 2022 as well, being that we're at the end of the year here and going into 2023. So to start, in the fourth quarter, some of the broad indexes, stocks and bonds both had a rebound compared to what happened for most of the year in 2022. As you can see, the fourth quarter was green for domestic stocks in the S&P 500, international stocks, the MSCI All Country World Index there, positive, beating domestic stocks by a couple percent there. Bonds were positive as well in the fourth quarter, and commodities were positive too, not as much as stocks, but as you can see, everything being green in the fourth quarter, that was not the case for the rest of the year. Stocks and bonds both in the red. International actually beat domestic stocks for the first time since 2017. It's a site we haven't seen too much. But the rest of the story for 2022, as everybody knows, it was market pain. Everybody experienced it. The S&P 500 actually had its worst year in 2022 since 2008. The Bloomberg Bond Index had its worst year ever since the inception of the index in 1976. In fact, 2021 to 2022 was the only 2-year period where the Bloomberg Aggregate Bond Index finished negative 2 years in a row. First time that has ever happened, which is just amazing. Bonds did not offer the protection that many investors look for in 2022. When we move on to commodities, however, and this kind of speaks to what Vern mentioned with our inflation protection allocation, which has a decently sized commodity allocation. It had one of its best years in a very long time, represented here by the S&P Goldman Sachs Commodity Index, up almost 26% in 2022. And in fact, between 2022 and 2021, speaking of 2-year periods, like I mentioned for the aggregate bond index, this was the best 2-year period for commodities since 1999 and 2000. So that general trend sort of frames how it went for our models as well in 2022. I'm only going to hit on a few of the more notable models in this presentation today, and the effort of keeping it short, like Vern said. But again, reach out if you want to learn more about some of the models I don't hit on today. I'm going to try to tie in the models Vern mentioned in his portion and hit those and how they did in 2022 and how they're allocated currently going forward into 2023. So it may be a kind of a quick shot here with the view of all of our models, but this information is available on our website. You can reach out to us. We can send it to you for a full performance report at any time. So with that being said, I'll move on to some of the more model specific views we have here, starting with our post MPT allocations. First, before we get into the performance, I'm going to hit on some of those trends that Vern mentioned with how they're allocated. Here I show for both the post MPT growth allocation and the post MPT moderate allocation, the allocation changes over the last 5 months or so. And as you can see, both models have a fairly high energy allocation. It's actually come down a bit in this most recent month in moderate, but that high energy position has been there for most of 2022. And that's what's helped both models outperform their respective indexes in 2022. Post MPT growth outperforming the S&P 500 index, and post MPT moderate outperforming a 60/40 stock bond blended index in 2022. Moderate actually performed, if we go back here, you can see moderate actually performed a little bit better than growth did in 2022, down about 8.5% compared to down about 9.7% net of iSectors management fees in 2022. But with the S&P 500 being down just over 18%, 60/40 stock bond down almost 16% at about 5.8% there. Moderate and growth both had decent outperformance in 2022. Due to this high energy allocation, growth has had that high gold miner allocation Vern mentioned. That's really increased in recent months and was the driver of outperformance in the fourth quarter for growth versus moderate and versus its benchmarks in the fourth quarter as well, which made up for the slight underperformance for the first 3 quarters of the year. The utilities Vern mentioned also, they are represented in post MPT growth more so than post MPT moderate, because moderate having a lower risk tolerance has a higher bond allocation, um, as opposed to growth, where growth, has some of that sort of recession protection in the form of utilities and gold, as opposed to pure bonds like in post MPT moderate. Um, so speaking of, you know, gold and energy, we move on here to our inflation protection and precious metals recap. Both of these models had great 2022s. The fourth quarter was solid as well. If we can scoot back up there to see, uh, precious metals in the fourth quarter was over 12% up, which actually drove it, being net of fees, to be our only positive performing model in 2022. Um, but both of them, even inflation protection down about 1.2%, they were our best performing models in 2022. Inflation protection, mostly, if I go back, I'll go back to that other slide I was just on. The asset classes I have represented on the chart here are what make up most of the inflation protection allocation. BCD being a broad commodities ETF, you can see the performance. This is 2022 performance here. Far and away, like we saw with the commodity index I showed earlier, far and away being the best performer. Gold performing fairly well, about in line. That's SGOL is the gold ETF. STIP is short-term inflation protected securities, which also performed very well in 2022, much better than the vanilla cousin it has just in broad tips. Those suffered in 2022 because of the interest rate exposure. As interest rates rose, it really hurt the performance of the broad tips index. But we use the short-term tips index in our inflation protection model, and that really so it tamps down some of the interest rate risk and some of the volatility that can come with the broad tips index. So short-term tips were good as well. All three of these asset classes outperforming equities in 2022, outperforming equities and bonds for that matter. So if you wanted to be diversified and really have a diversified allocation in 2022, you would have needed some sort of model like our inflation protection model or an alternative model. Precious metals would have been great as well. A little more volatile than our broad inflation protection allocation. But both of them performed great in 2022. And as Vern mentioned earlier, would have a great place in portfolios for 2023 as well, both in the form of, risk of elevated inflation in 2023 or possible recession as well. So it's kind of a two-pronged approach there. Okay, moving on to our domestic equity allocation. This allocation hits on some of the quality dividend focused ETFs that Vern referenced earlier. We did increase in the fourth quarter. We increased the allocation to quality dividend and value focused ETFs to about 80% of the portfolio versus 20% in growth ETFs, which you can see here another sampling of some of the names we have in the portfolio. Noble is the S&P Dividend Aristocrats Index, which only includes companies that have increased their dividend for 25 consecutive years. One of the more well-known sort of quality dividend type of plays in the market. It well outperformed the S&P 500, both that and VUG, which is the Vanguard Growth ETF, which is the growth exposure that we have in the model. Growth really struggled in 2022 after really bouncing hard in 2020 and 2021 due to the tech names going off because of a lot of the printing of money and the increase in money supply. It's come back down to earth in 2022 here, as you can see in VUG. We expect that to continue going forward into 2023 as well, which ties into the increase that we made actually in these quality dividend type of names in the fourth quarter. We had been about 75%, 25% in dividend versus growth ETFs, but we increased that tilt because that's already a fairly aggressive tilt, but we went even further, increasing that tilt from 75 to 80% in the dividend ETFs versus 20% in the growth ETFs. Sort of with the expectation that this trend you see here will continue forward into 2023. And at the very least, even if the raw performance of growth rebounds a bit, the volatility of names like Noble is much less than what you'll see in the broad S&P or certainly in growth ETFs. So that was kind of our reasoning there and reason for our outperformance in 2022. In fact, if we'll go look at it, our domestic equity allocation is down or is up about 11% in the fourth quarter but beat its index by over 4%. And it performed even better than the bond index did for the year. So if you can get equity names that perform better than bond names in a year, it's mainly due to those dividends that I showed. It's pretty impressive. Um, and like I said, we're hoping that continues going into 2023. So after speaking on our domestic equity allocation, I'll move on now to our domestic fixed income allocation, which ties in earlier to what Vern was talking about. Decreasing our high yield exposure is what happened directly in this model in the fourth quarter. Um, we had about 40% exposure to high yield in this portfolio in an effort to get some income and increase the yield of the portfolio, and as a part of a client's fixed income allocation, that yield was nice. A lot of advisors like that. But now with the increase in interest rates we saw throughout 2022 and heading into a possible recession in 2023, we were able to get some of those same yields that we were getting last year in these high yield ETFs we owned. And we're getting that in investment grade corporate bonds and even treasury ETFs that we've added to this model in an effort to increase the average credit quality of the portfolio as a whole. And so in saying that, we're also keeping the duration of the portfolio about the same, which was very short. It was shorter than the Barclays Ag. That's what it used to be called, the Bloomberg Aggregate Bond Index. The duration of this portfolio is about 2.5, and that's what it was before we made these changes, and that's about what we're keeping it to now. The ladders we're using are between a 1 and a 5 year ladder, depending on it, whether it's investment grade corporates, high yield, or the treasury allocation that we added. So staying very short, and just as an example of the short-term bond exposure really helping the performance of this model in 2022, I have a chart here with short-term bonds represented by SHY, the SHY ETF, which is 1 to 3 year treasury bond ETF, and TLT, which is the long-term treasury bond ETF from iShares. As you can see, 2022 was a rough year for those longer duration bond plays, and it's helped being short. And we're still going to stick with that going into 2023 as well, given the volatility. Even if the Fed doesn't hike much more, if they keep these rates elevated like this, having shorter term bond plays is just going to keep that volatility down. And then paired with the higher credit quality of the treasury ETFs we added, we've put ourselves in a really good position, we feel, for two of those three prongs that Vern mentioned between recession, inflation, and higher interest rates. We kind of have two of those covered with this model here. So that's the last model I'm going to point out for now. As you inspect the disclosure page here, I just want to thank everybody for joining us today. I'll move on from the disclosures now so you can have our contact info that I mentioned earlier in case you want to reach out to us. I'll put Vern and my picture back up now so that you can see us one more time in the corner before we go. Like we said at the top, this is a new format for us. We kind of changed how we did it. We wanted to show our faces a little bit. And so please give us any feedback. If you watch this, let us know if you enjoyed it. If you want to see anything different from us, you can call Scott or myself here. I have us on the page. We just want to provide the best information that we can to anybody watching this. So please let us know. I'll bring up Vern in my full picture now. We'll be happy to talk on any more of this. We wanted to keep this 20 minutes was about our maximum. We're getting close to that now, just so it doesn't drag on forever if anybody wants to actually watch this whole thing. So if you did watch, we thank you very much, and we'll be happy to help with any sort of asset allocation needs that you may have or any questions you have about your clients' portfolios in 2023. So Vern, I don't know if you have anything else to add.
Talk to you next time.
Yeah, that sounds good. Talk to everybody next time. Thank you everyone for watching, and have a great day.
Bye-bye.